Elliott wave theory. In this video, you will learn the principles of Elliott wave theory, identifying motive and corrective waves, wave structure and degrees, and how to use Fibonacci ratios and wave guidelines for better trading. Elliott wave theory was developed by Ralph Nelson Elliott in the late 1920s. After examining 75 years of stock market behavior, he noticed repetitive patterns in all different time frames, which he attributed to the psychology of masses. He divided these large patterns in smaller patterns, which he called waves. Under the wave principle, every market transaction is both produced by meaningful information and produces meaningful information. Although it is the best forecasting tool in existence, the wave principle is not primarily a forecasting tool. It is a detailed description of how markets behave. Many areas of mass human activity follow the wave principle, but the stock market is where it is most popularly applied. The motive wave is the first half a complete Elliott wave cycle. It always advances in the direction of the trend of one larger degree, and it is subdivided into 5 smaller waves, labeled as 1, 2, 3, 4, and 5. 3 of these waves, which are labeled 1, 3, and 5, are impulse or actionary waves that actually affect the directional movement, or in other words, move in the same direction as the trend of one larger degree. These impulse waves are separated by 2 diagonal or corrective waves, labeled 2 and 4, and are a requisite for overall directional movement to occur. In order to identify a proper motive wave, the following rules must apply. Wave 2 cannot retrace more than 100% of wave 1. Wave 3 can never be the shortest of the directional waves 1, 3, and 5. Wave 4 can never overlap or enter the territory of Wave 1. Remember that these rules are unbreakable. If one of these rules is violated, then the structure is not a motive wave and the count must be wrong. The corrective wave is the second half of a complete Elliott wave cycle. Corrective waves move against the trend of one larger degree and represent a pause within the larger operating trend. The corrective wave is subdivided into 3 smaller waves denoted by the letters A, B, and C. One complete Elliott wave cycle constitutes 2 phases, the motive phase and the corrective phase. A cycle is illustrated as a structure with a total of 8 waves, 5 waves that advance in the direction of a higher degree trend, and 3 corrective waves against the higher degree trend. Elliott noticed that the market repeated this 5-3 structure again and again. Once the cycle ends, it begins again. If we incorporate our expanded motive and corrective waves together, we will see that they make a more detailed general Elliott structure. We can see 5 advancing waves in the motive wave that make up wave 1, and 3 declining waves in the corrective wave that make up wave 2. Notice, however, that in waves 1 and 2 of wave 1, the general 5-3 Elliott structure forms, and this structure forms on both a larger scale and a smaller scale. Elliott noticed that the market repeated this 5-3 structure again and again. Once the cycle ends, it begins again. And each wave and cycle can be part of the bigger 5-3 structure of waves. The relative wave degree is used by analysts to identify the position of a wave within the overall progress of the market. Elliott acknowledged 9 degrees of waves from the grand supercycle degree, which is usually reflected in monthly timeframes, to subminuet degree, which is reflected on hourly timeframes. Although this sounds confusing, you shouldn't be confused, because the precise degree is usually irrelevant to successful forecasting, since it is the relative degree that matters most. To know a major advance is due is more important than its precise name. and later events always clarify the degree. Different waves in an Elliott wave structure relate to one another according to Fibonacci ratios. Fibonacci ratios are useful to measure the target of a wave's move. This relation can, therefore, help traders determine good entry levels and profit targets. In the motive phase, the following usually holds. Wave 2 typically retraces 61.8% of Wave 1. Wave 3 is typically 161.8% or sometimes 261.8% of Wave 1. Wave 4 typically retraces 38.2% of Wave 3, but no more than 50%. Although these guidelines work 75% of the time, they are not unbreakable rules, and therefore traders are advised to always use good risk and money management when trading. The guideline of alteration implies that in a 5-wave sequence, Wave 2 and Wave 4 will alternate in shape or style. If Wave 2 is a sharp style of correction, Wave 4 will be a sideways style of correction. And if Wave 2 is sideways, Wave 4 will be sharp. This guideline is useful for potentially projecting the end of Wave 4 in a motive wave. Among other guidelines that can help traders is the guideline of equality. It implies that in a 5-wave sequence, 2 of the motive subwaves will tend toward equality. This is mostly true for Wave 5 and Wave 1, which tend to be equal in price. This guideline is useful for potentially projecting the end of Wave 5 in a motive wave. The guideline of divergence implies that when 5 breaks beyond the span of Wave 3, momentum oscillators show divergence. As the price breaks to print a new higher low, momentum oscillators fail to do the same and diverge. This guideline is useful for potentially projecting the end of Wave 5 and the beginning of a corrective wave. The guideline of the depth of corrective wave implies that the market will often correct to the territory of Wave 4 of lesser degree. The corrective wave will not always reach the bottom of the previous 4th wave, but rather its span. This is usually a good place price to find support or resistance before the trend continues. Two features of this theory can create some confusion regarding wave count, and they are the extensions of the impulse waves and the alternating types of corrective waves. Most of the time, impulse waves will display an extension to their normal pattern. One of the impulse waves in the motive phase will take the form of an elongated impulse with multiple subdivisions. Extensions occur in Wave 1, 3, or 5. However, Wave 3 is the most common wave to extend. Sometimes, the subdivisions of the extended wave look similar to the other 4 waves of the motive phase, resulting in a wave count of 9 instead of 5. Furthermore, since the extended wave is originally an impulse, further extensions can also occur within extensions, making the wave count even more confusing. When the market corrects against the trend, it does so with a struggle, and these allow the corrective phase to take various shapes. The zigzag is a 3-wave corrective structure labeled ABC with a subwave sequence of 5-3-5. Waves A and C are motive waves, while wave B is corrective. It is a sharp style of correction that usually shows up in wave 2 of the impulse wave. The flat is another 3-wave corrective structure, also labeled ABC, but with a subwave sequence of 3-3-5. Waves A and B are corrective waves, while wave C is a motive wave. It is called a flat because it develops in a sideways direction and usually shows up in wave 4 of the impulse wave. Not all flat corrections look perfect like this. A more common type of flat is the expanded flat. In an expanded flat, wave B ends above the start of wave A, and wave C ends below the start of wave B. The triangle is a 5-wave corrective structure labeled A, B, C, D, E with a subwave sequence of 3, 3, 3, 3, 3. Its subwaves are mainly corrective and form patterns of threes, but sometimes may take the form of complex combinations. Triangles may take various forms like ascending, descending, contracting, or expanding, and usually show up in wave 4 of the impulse wave. These various correction types just highlight the level of complexity that Elliott wave theory possess. Thank you for watching.